All right, we're going to go ahead and get things started here. Thank you so much, everyone, for joining us. We're going to talk about today 7 smart moves to keep more money in your pocket before year end. I'm Jake Alexander from Action Accounting. Thank you so much for taking a little bit of time out of your day to join us today. I have some amazing guests. I got my friend Adam Taylor here and also Thomas Barber. And we're excited to talk about this stuff here and spend the next little bit of time with you. So thanks so much for taking the time out of your day. We're going to go ahead and jump right into it. So in true accountant fashion, we got to have an agenda so everyone has good expectations. Everyone knows exactly what to expect. I always like to put this together just to cover exactly what we're going to cover in today's session. We always start with introductions. At the end of the day, we tell clients, or we tell everybody, this presentation isn't about us, it's about the information. But we like to do introductions and just tell everyone a little bit about the people who are up here speaking, just so we're not perfect strangers up here talking to you guys today. So quick introductions from us, a little bit about our hosts. From there, we're going to go into the big picture. We're going to talk about the tax code. I like to do this to really just set the stage and talk about the tax code. If we take a step back from a big picture, what is it, who is it for, and how does it actually work? So just a few minutes setting the stage there. And then we're going to really jump into the main section, okay? And this is where we're going to talk about our 7 smart moves. We're going to talk about keeping more money in your pocket and make sure at the end of the day you're really set up for success and give you some tangible things that you can walk away with to really make this stuff work for you. And at the end, we always do a wrap up. We do a recap of everything. We do question answer, and we schedule these events for an hour. Really, the content section's about 35 or 40 minutes. We do that on purpose. We love to talk about this stuff. We love to educate, but we also want to make sure everyone's getting the most out of it that they possibly can. So we leave plenty of time at the end for Q&A. But I want to make sure everyone knows how to interact with us throughout the course of the event as well. So if you haven't noticed yet, this is a little bit different than like a typical Zoom meeting where you can turn on your camera and you can raise your hand or whatever. This is the webinar version of Zoom. We do that to make sure everyone gets value out of it. But I want to make sure everyone knows that we want to interact with you and we want to hear your questions throughout the thing too. So the way you do that, there's a little Q&A box down there on the bottom. And just to do a little bit of like a technology check, I want to make sure everybody can see me, everybody can hear me. Find that Q&A box and just type in there something. Type in something that comes to mind when you think about taxes. Type in your first name and the city that you're joining us from. I just like to make sure that that works before we get too far along with things here. So do me a favor, find that Q&A box, type something in there so we know that you guys know how it works and everybody's out there. So Peter Gray, hey Peter, yo, right back at you. So thanks for joining us. We do want to make sure that works and we do want to interact with you throughout the course of the program. So that's for our agenda. From here, we'll jump right into it. So I'm going to introduce Adam Taylor. Adam Taylor, how you doing today?
Fantastic.
Awesome. Thank you so much for joining us. So Adam Taylor, he's a CEO. He's a wealth management advisor with Taylor Financial. He's a sommelier. If I said that right, that's like a fancy term I'm not used to using so much, but you could maybe tell us more about that. What is? Turned business owner, and he is the youngest managing partner ever with the Capital Grill. I can tell you honestly, I've known this guy for a while, and he really takes the hospitality mindset that came from the restaurant industry over to what he does now with the wealth management and financial advising stuff. He started Taylor Financial back in 2018 all by himself and grown it into what it is today. He's won all kinds of awards, fastest growing business. He's nominated for Small Business of the Year constantly by the Tampa Bay Chamber. And he's really, at the end of the day, he's a student of the business. He has more letters behind his name than he does in front of his name. If you see up here all these fancy titles right here, I don't even know what half of those mean, but didn't you get another one of those recently too, Adam?
I've got one more test to take, so not yet, but give me a month and a half.
There we go. But you recently got one on tax planning, which is what we're going to talk about today here too. So that's Adam. Thank you so much for joining us. Then we've also got Thomas Barber, which I think he might be having a little bit of technical difficulties, or he might have just joined in right at the last minute here too. But Thomas Barber, he's an expert in financial services. He has been in the financial services industry since 2000, so 25 years going on in this industry. He's the executive vice president of Park Hill Capital Group. He's heavily experienced, extremely networked in the industry, which anyone in our industry in tax and accounting knows that that is crucial and very, very important. Specializes in tax planning and structured finance. Thomas, How are you doing this afternoon?
Doing extremely well. Thank you very much, Jake. Nice to meet you,
Yeah.
Adam.
Thanks for coming. I was reading in your bio before this too. So Thomas, you actually graduated Cornell University and played defensive linebacker too. Is that right?
I did. I came in as a quarterback and left as a linebacker, much bigger and slower than when I first came in. So yeah. And I have 2 damaged shoulders to show for it.
To prove it, right? That's amazing. I played a little bit in high school, didn't quite make it to the college level, but not to brag or anything, I actually currently coach my 5-year-old's flag football team,
awesome.
and we won the
That's
championship ring this last season. So we have a little bit in common there too. So those are our guests for today, Adam and Thomas. A little bit about me. If you're watching this, you probably already know who I am, but just to make sure, I'm Jake Alexander. Action Accounting is the name of our business. We've been around since 2016. Grown to a team of 11 of us, somewhere between 500 and 600 clients spread out all around the country. And we got 4 major departments in our business. We have bookkeeping, which there we create financial statements for business owners. More than just create them, we teach them how to read them. So we actually show them by looking at your P&L, by looking at your balance sheet on a regular basis. This will help you make more informed business decisions. We've got a tax preparation department where there we prepare and file tax returns for businesses and respective owners of the business on a regular basis. Then we've also got a tax planning department, which I like to separate the two because they are 2 totally separate disciplines. Tax planning is what we're doing right now. It's proactively learning new strategies, coming up with new ideas, implementing things ahead of time, which I applaud all of you who are joining us today, because that's what you're helping us do here, is do some proper tax planning and save money for the future. And then last but certainly not least, we have our business consulting division, where we help business owners put systems and processes in place for anyone looking to grow and scale their business and turn it into a profitable, sellable asset. We can help with that too. So you can always reach us at actionaccountingusa.com or on all of the major social media channels out there. And so that's just a little bit about us. Somebody is typing in there, the chat is disabled. The chat is disabled, Elena. That's because this is the webinar version of Zoom. So where you're typing in the Q&A, that's exactly where you got to do it if you do have a question. So thank you for pointing that out. All right, just real quick. So I'd like to talk about, just to kind of set the stage, we start talking about the tax code. We'd like to explain to clients why we're different. And so the biggest difference is we talk about proactive tax planning. If you know me, I talk about that all the time. So you're probably saying, well, Jake, that's not that big of a deal because you talk about that all that stuff all the time. But that's actually what makes us different. In reality, most accountants are historians. They're very focused on the past because they're so focused on gathering all of your documents for the previous year to get everything done and filed by the deadlines. And for whatever reason, a lot of accountants enjoy saying no. I don't know if anyone out there has ever found a new strategy on social media or whatever it is and brought it to their accountant, and for whatever reason, they instantly shoot it down. We're not like that. We're proactive. We're strategists at the end of the day. We work forward, not backwards. We help you write the story, and we enjoy coming up with creative ways to say yes to our clients. And so it's a little bit about what makes us different. The reason that stuff's okay, I love to start with this quote here. This is a quote by Judge Billings Learned Hand, who was a U.S. State Court of Appeals judge back in 1934. And so this is an official court opinion that still, to this day, almost 100 years later, has never been overruled in court. And what he said is, anyone may so arrange his affairs so that his taxes shall be as low as possible. He's not bound to choose the pattern which best pays the treasury. There's not even a patriotic duty to increase one's taxes. And so to me, what that says is that this stuff is okay. It's okay to position yourself in a position to win. It's okay to use strategies. It's okay to move things around and do all this kind of stuff, because that's what the IRS tax code is written for. At the end of the day, it's written for business owners. The reason why is because 2/3 of new jobs in the United States are created by small business, and up to 40% of economic activity at the end of the day is attributed to small business. And when you understand what the IRS is, at the end of the day, they're really just a debt collection agency. They're the biggest, most powerful one in the world, so you don't want to mess with them by any means. But at the end of the day, the IRS's job is to collect money from taxpayers. Your job is to give them the least amount of money as possible. And so it's all about being proactive versus reactive at the end of the day, which is what we're all doing. We're focusing on tax planning instead of tax prep. And at the end of the day, it comes down to what's the best approach for you as the taxpayer. In my opinion, there's really 3 different types of taxpayers out there. There's the ones that they file their taxes. They send all their stuff to their CPA, or they bring all their paperwork into their accountant, and you kind of cross your fingers and you hope and pray that the number's not too big of what you got to pay at the end of the year. You don't want to do that, right? Then you kind of have the middle of the road where you've heard of some of this stuff. You maybe know enough to be dangerous. You've seen some videos on TikTok of gurus or experts talking about this stuff, but you just know enough to be dangerous. You don't fully quite know how to bring it all together. And then even worse, you might even be bringing some of those to your current accountant, and then they're instantly shooting them down, which is not a good situation to be in. Or there's people that plan year round. This is people who work with a team of experts. And in my opinion, that's where the real magic happens. So that's the level of service we provide to our clients, and we want to educate and entertain you with all of this stuff today. I'm going to turn it over to Adam Taylor here. He's going to talk to us a little bit about retirement plans and leveraged investments. So Adam, take it away, sir.
Yeah, sure. So we'll touch base on the 2025 contributions that you can do into retirement plans, and then we'll talk about oil and gas. I think Thomas is talking more about leveraged donations. Is that correct, Jake?
Yep.
Charitable marketing campaigns is what we're calling those.
I like that. So as a lot of you know, that each year it seems like the contribution you can put into some type of retirement plan for a defined contribution or defined benefit plan increases each and every year, but you're able to put up to $23,500 into a 401k, 403b, 457 each and every year if you're under the age of 50. We do have a lot of our business owner clients start solo 401ks, whether in the traditional or in the Roth space. So it's a great opportunity to put more into a retirement account other than an IRA, where we're limited to either $7,000 or $8,000, depending if you're under or over the age of 50. So if you're between the age of 60 and 63, this is somewhat new, you can actually do more than the catch up of the $7,500 into a 401k. You can do $11,250. So another great opportunity to get almost $35,000 a year into a either tax deductible traditional account or even a post-tax Roth account. We have some clients that want to layer on top of a defined contribution plan through 401k and profit sharing, and they go into defined benefit plans like the old school pension or cash balance plans. And it's a way of getting a few $100,000, if not more, into a tax deductible plan. So really from the low side of IRAs all the way to the high side of defined benefit plans, there's a great opportunity to set some money aside for long-term growth, which is fantastic. So that's kind of not old news, but not as attractive as what we're talking about with a lot of clients now, which is the oil and gas contribution. I personally believe, as we have Chase, the attorney, walking up there, there's Chase. I personally believe that energy sector in general as an investment will continue to rise in the coming years, mostly in the nuclear and the natural gas aspect. I do think with the rise of AI and just the need for energy, natural gas is one of those solutions. So one of the investments we do for clients is through a company called MDS Energy Development Corporation. And what they do is they do horizontal drilling or fracking into outside Pennsylvania or around Pennsylvania in the Marcellus Shale to be able to generate natural gas. And with this investment, we can do what is called intangible drilling costs, IDC. So if you invest in this fund, you're able to deduct 70% year one, year two, 16%. And then after we are done with the first 2 years of potential deductions, you can turn it on as an income stream. So it's a great way to diversify your portfolio, to maybe go after an area that we think is only going to rise. And that investment, let's say it's $50,000 or $100,000 or $500,000, can really substantially reduce some of your adjusted gross income, but also provide some mailbox money in the future. This company, MDS, has been doing it since 2015. So they have over 9,000 investors. They have over $1 billion invested. And for 2025, they are raising $200 million into their fund to help with intangible drilling costs, operating costs for these operations. So they've raised about 130 to 140 million. So we still have some left. But again, the goal there is that you get a nice tax deduction in year 1, year 2 as a general partner. Now, there are some risks associated with being a GP, which we can always talk about at a later date and see if that makes sense for you. But then as we switch to LP, having that passive income that shoots off anywhere from 1 to 2% a month, in a couple years, these funds are shooting off almost 3% a month, which is unheard of, not as attractive now. But 1 to 2% a month or 12 to 24% a year off of that original investment can be pretty helpful in one's overall plan. And even the fund from 2015 is still continuing to pay monthly distributions through a K1, right? So a great opportunity to take advantage of a certain sector, get some tax deductions, and have some future passive income for one's financial plan.
Adam, that's amazing. And so just to kind of recap here, and I'm typing these into the chat as everyone goes down because we're going to talk about 7 total strategies today. So your first one's retirement plans. So if someone's a W-2 employee out there, they want to maximize contributing to those 401k plans, right?
Yeah, or even if you're a sole proprietor, or if you're an LLC, or if you're even an S Corp. So if you're a business owner in some structure, there's a way to set up 401ks. We can set up solo 401ks. We can set up what is called simplified employee pensions, or SEPs. Or if you have some team members, we can even set up a full 401k, or we can do a simple IRA.
Nice. So lots of different options out there. Depending on the level of income you're dealing with, would probably gauge which one of those accounts they want to set up and contribute to, right?
Correct. And it's also going to determine, do we do traditional contributions or Roth contributions? Depending on where they are from their bracket and their overall marginal tax rate, we may want to try to fill the bucket of a 22 or 24% bracket to take advantage of some long-term post-tax. Or if they're in a 32+% bracket, well, maybe you want to look at some tax deductions like traditional contributions. So yes is the answer, Jake.
I love it. So you need to have a retirement plan. What kind depends on how much you're making, how much you want to put away for retirement. And then on these leveraged investments here, we did ask, somebody said, what's the name of the fund to invest in again, Adam?
Yep. So it's called MDS, like Michael David Scott, Energy Development. And perfect. I do have to mention that you have to be an accredited investor. So you have to have either $1 million net worth, excluding your home, to be able to get into this, or you have to have income of $200,000 a year for the last few years if you're single, and 300 plus if you're married. So this is not right for everybody, right? So if this is putting all your money into this, probably not the best idea. The minimum investment's $50,000. Again, there's a lot of risk that comes with this, but there is a risk and reward pendulum, if you will, that we believe can be right for someone's overall plan. So yeah, if you Google, and again, I have all the documentations. I don't want to send it out to everyone because I want to make sure it's appropriate. And if you're not an accredited investor, which is somewhat easy to self-claim, if you will, these days, then yeah, I'm more than happy to kind of share all that. But great way, and I think obviously we're very bullish in the market in general, but very bullish within domestic AI and tech. And so if there's some type of sector, or even like the natural gas energy that we believe will help to fuel, no pun intended, the need for the energy on AI, it's a great way of doing that.
That's great. Thank you so much, Adam. And I know you said a lot of very important, very technical stuff. If I could try to kind of simplify it as much as possible, would it be fair to say, so these leveraged investments in the natural gas industry, it's essentially a way to invest money now, strategically get tax deductions, and then also create an income for yourself down the road?
Correct, and using an area and a sector that I think is on the rise. And if you look at America back in 2005, there's a significant domestic natural gas shortage, and it was one of the world's largest importers of natural gas and oil. Well, if you fast forward 20 years in 2025, we're now, as America, one of the world's largest natural gas oil producers and one of the largest natural gas and oil exporters, not importers, right? So there's been this big shift, and I do think that as we continue to need more energy, we have to look at how efficient can we create these energy areas, and I think that's going to be nuclear, natural. I do think crude oil will come back too. That's a whole other conversation with the EV market and kind of what's happening there, and where I think a lot of these automakers are going. But for the most part, yes.
We're going to need to power all these computers that are eventually going to run the world and do all of our jobs one day anyway, right?
Exactly.
Nice. Well, thank you so much. We do have a question on the accredited investor. Somebody said you can't include your primary residence, but can they include the value of their second home to qualify as an accredited investor?
Yes. Or
okay,
yes is the answer. And or if they have, like Thomas and I, if you have a Series 7, a 6.5, a 2.2, if you have some type of professional license, then you would immediately qualify for accredited investor as well. If you are a general partner or executive officer or director of an insurer, director of the insurer of security. So again, if you're in somewhat my field in some type of a C-suite role, then you would be an accredited investor too.
Nice. Thank you so much, Adam. Thomas, we're going to turn it over to you. Talk to us a little bit about charitable marketing campaigns.
Yeah, so thank you very much, Jake. Great to meet you, Adam, and it's great to meet everybody here. Park Hill, the company that I work for, Park Hill Capital Group, is a leader in this space. We've designed a pretty innovative solution for clients to participate in, and oddly enough, there's actually 3 parties that are involved in each transaction. So if you looked at a triangle upside down, with the point at the bottom is where a high-income taxpayer can participate in one of our campaigns. And they might be motivated to mitigate their tax, be philanthropic, or a variety of other things, because there is an impact initiative that is fulfilled on the back end of the transaction. In the top right, we have a nonprofit 501c3 that obviously has an interest to share their charitable mission with our high-income earning taxpayers and emerging high-income earners. So they would love for those people to understand what it is that their charitable mission is, and ultimately could lead to future donations, although not required. And then on the top left of the triangle, let's talk about the technology companies. So we have relationships with companies that have disruptive technology, and they also would like access to our distribution of high-income earning taxpayers and those parties who have the discretionary capital to buy their products direct. So you as a taxpayer can help fund one of these charitable campaigns that we've developed and ultimately participate in a way, because of the nature of the design of our transaction, to put in $1 and receive a value of a potential tax deduction that could be as high as $5 of tax deduction for every $1 of contribution. Obviously, I'm leaving a lot out, but that is essentially the economic value that can be generated from the transaction if you choose to donate. But there's a laundry list of other things that you could do with the asset if you desire to do that. Do you have any other follow-up questions to that, or you want me to continue to dive in?
You're on mute, Jake.
Keep going, Thomas. That was great.
So I can talk about one of our campaigns that we're running this year, and essentially we're running 5 campaigns in total. Those 5 campaigns are involving different technology companies along with different participating nonprofits. There always has to be an alignment between the for-profit company and the technology that they make and the nonprofit party on the other end. So the one campaign that we're going to talk about today is tied to a company called Neural Labs Inc., and their product is called Neural Earth. Very similar to Google Earth in in what it does, but it does so in a much different way. So think of an AI-powered satellite-based technology that can zoom down onto any geography that the subscriber so desires. And it can then thereafter use data and geospatial data to identify a variety of climate-related risks that can impact the asset with which it's now zoomed in or targeted into. That would give that asset holder a completely different way to manage that asset in the future, because it can identify a risk metric score that identifies the variety of climate-related risks that can impact that asset in a specific way. Let's think about Miami, right? Miami has hurricanes and wind, right? Those are two metrics that can be identified. Whereas if we went out to California, fire has been a big issue, mudslides. These are different climate-related, activities that can be identified within the software. And ultimately, they would like our distribution to understand who they are, what the technology does, and ultimately, they're trying to get out to the world the technology at a faster scale that they can do on their own. So taxpayers can come in to our campaigns and help contribute capital to those campaigns, and part of that money goes to the manufacturer, part of it goes to third parties, part of it obviously is retained by us for administering everything. But what they get in return is the ability to secure an asset at a deep discount to its fair market value, which ultimately can be used to order the product or to donate the asset and receive an outsized charitable income tax deduction associated with that donation. The beauty of what we do is that in the normal context of donations, if you were to buy an asset today, let's call it a piece of art, and that art had $100,000 value, and you were able to secure it for $50,000, and you decided day two that you wanted to donate it at the higher price. Well, the issue there is that you have a 1 year and 1 day holding period to donate that asset at its fair market value. So even though you bought it at 50% of what it's worth, you can only donate it and get the value of what you paid for it. In our transaction, by the nature of its design, we do not have a holding period. So they literally can participate in Q4 anytime between now and the end of the year, call it December 12th, when we close our initiative, and they could receive the outsized tax benefit of that donation at its full fair market value. So think of it like the Costco model, buying something at 20 cents and being able to donate it at $1. That gives them $5 of buying power and ultimately up to $5 to deduction to then offset their adjusted gross income. And the beauty of our solution is it offsets all forms of income: active income, passive income, W-2 income, even exclusively W-2 income, and capital gain, or any combination thereof. And by the nature of the asset that we're donating, the charitable rules allow us to offset up to 60% of the adjusted gross income. So we're talking about meaningful tax savings, and to do so in a way depends on the tax jurisdiction with which the taxpayer is in. If you're in Florida, or let me change that, if you're in Tennessee like me, there's no state income tax. So the benefit isn't as great if you're on the lower income threshold. But if you're on the higher income threshold, it still makes a lot of sense offsetting your federal tax only. If you're in a high income threshold, say California, New York City, in these other areas that are high income tax areas, you can have much lower income. I wouldn't say much lower. You can have lower income and receive significantly more benefits because you get both the federal and the state benefit. And if you looked at a no income tax state compared to a full income tax state, let's look at $1 million taxpayer. If you had $1 million taxpayer in Tennessee, we could basically create a cash on cash return up to 166% on the contribution that would be an optimized contribution for that $1 million taxpayer. And in California, that same contribution could provide a 206% cash on cash return. So that is the equivalent of participating in a transaction that's not tied to the market or the ups and downs of the market, where if you gave me $1, I could give you back $2. That's if you're in a high income tax state. Again, there's a range there depending on the state that you're in, but there is massive planning potential here between now and the end of the year to secure some significant tax savings, assuming you meet the income hurdles that we typically have. And I would say those income hurdles are generally household income of $500,000 or more. It makes a lot of sense. In high income tax states, sometimes we can go lower, but again, that is all forms of income. So if you sold a piece of real estate, that capital gain is included. If you have a business interest, if you have performing assets, rental income, and all sorts of other types of income, we look at all in aggregate and we can offset that in a meaningful way through your participation.
Thomas, that's incredible. Thank you so much. We're going to keep going here. If I could just recap that to try to bring it down to my level as simple as possible. It's most people are familiar with, if I donate $1 to my church, I get a deduction for $1. Essentially what you're saying is there's programs out there or organizations out there that are set up in such a way where if you donate, let's say $1, you actually get credit back for up to $5 on that same donation. Is that essentially kind of what we're stating?
Let me just revise your wording just slightly. So they're contributing capital to the campaign to help fund the campaign. What they're doing through that campaign contribution is they're acquiring a specific type of asset, and then they're getting that asset at a deep discount to its fair market value. And because of the nature of the asset type, there is no holding period requirement. Okay, so they can immediately donate that asset at its full fair market value, and they're basically leveraging the arbitrage between the pricing differential of the acquisition price versus its fair market value. Okay, so that is slightly different. They're not donating cash, they're contributing capital, acquiring a discounted asset, and then they have the ability to donate it at a higher level or its current fair market value.
I love it. Thank you so much for covering that. We're going to keep cruising along here, and we're going to go to depreciation, which is our number 4 tax move before the end of the year. A lot of people didn't realize the One Big Beautiful Bill Act that was passed several months ago. This actually changed depreciation back to 100%, specifically for business vehicles. There's a thing out there called Section 179, which is a beautiful section of the Internal Revenue Code, which says if you have a vehicle, use it for more than 50% business use, and it weighs over 6,000 pounds, you can actually take a deduction for up to 100% of the cost of that total vehicle, which is really great there. This can also apply to other business assets. I put in there business assets. People always ask us, is there ways to get creative and write off the cost of our boats and RVs? I'm here to tell you if that's a personal asset, the answer is no. However, this depreciation can apply to business assets, said boats, said RVs, as long as they're set up properly. We utilize the right infrastructure. They're used more than 50% business use. There are some ways to get creative around that. This is really great with cost segregation studies. So this specifically applies to short-term rentals, especially when taxpayers' income's over $150,000 per year. They can invest in short-term rental properties, then do what's called a cost segregation study, which is essentially a really fancy way of saying take the deductions faster than you would normally have to spread them out over almost 30 years. With the changes with the whole One Big Beautiful Bill Act, it changed it back to 100% depreciation, which prior to that it was going to be set at 40% for the year. So that's a big one right there. That's our number 4 smart tax move. Number 5 is entity structure. So I always like to spend just a minute and talk about this right here. We get a lot of questions around this. There's a lot of kind of misnomers or different strategies or whatnot, but I'm here to tell you picking the right entity for your business and for your setup is crucial to your success. At the end of the day, I just like to cover, there's a ton of them out there, but these are some of the most popular ones. There's a single member LLC, which is the easiest, most simple to set up from a filing and paperwork standpoint, but then also easiest to manage from a compliance standpoint moving forward. It is what it sounds like. It's a single member. So there's only one person who's the owner on there. This gets filed on a Schedule C on your personal tax return. So doesn't add a lot of complexity to your filing and compliance of what you have going on. Then there's partnerships. So this can also be LLCs, but they have multiple members. So if you do set up an LLC and you add your spouse on there as a partner, or your brother or other business partner, for whatever reason, a lot of times the IRS is going to now tax that as a partnership. It's not the end of the world. It doesn't necessarily mean anything bad, but it's really good to know that when you do that, now you're filing two separate tax returns at the end of the year. So now we're required to file a 1065 partnership tax return along with your 1040. There's also an S Corp. We get asked about these pretty regularly. A lot of clients will convert their single member LLC or their partnerships to be taxed as an S Corp. This can do wonders in saving you on the self-employment tax portion. There are some requirements there, but there's also some savings involved too. Thing to know here is once we convert to being taxed as an S Corp, then we got to file two tax returns. Once again, we got to file an 1120S and your personal 1040 at the end of the year. Then the C Corp, people still ask about these from time to time. I'm here to tell you, these are double tax. There are reasons and there are times when they can make the most sense, but a lot of times these are somewhat of an entity of the past, depending on the situation, depending on what you have going on. The thing to be aware of here is if you do set up a C Corp, you want to be very aware of what your net profit is at the end of each year, because the corporation itself pays taxes on the net profit, and then you're going to pay it at the personal level as well. So just a little bit about entity, having a conversation to make sure you have the right structure, to make sure you have the right setup. A lot of times, for whatever reason, we see people overthink these, or get the kind of advice that they need to have 10 different ones in 10 different states. A lot of times that's not the case, but depending on what you have going on, there are some reasons that could make sense. Then we talk a little bit about family office. This is kind of an interesting one here. A lot of people don't realize, and if there's times where it makes sense, you could potentially add your spouse or children to the payroll if you have a business that is successful and profitable. A lot of people don't realize if you have dependents, they can't actually work for you inside of your business. They have to actually perform a role or service. You have to pay them in line with going market rates. But a lot of people don't realize you can pay them up to $15,750 per year per child. That money would then be a deduction from the business income and then tax-free to the children if that's their only income for the year. Can be a great strategy right there. There's also times when it makes sense. We might be looking, if one spouse is a business owner and the other is not or doesn't have income, there could be times where it makes sense to add them to the payroll as well. So we want to make sure we're qualifying for all the credits out there, like the child tax credit and the dependent care credits. There could also be times where this opens you up to additional business deductions like vehicle deductions, travel, all sorts of other interesting stuff as well. If you do set one of these up, the easiest way to set that up and to manage it is to set up a single member LLC, kind of like we were talking about with the entity structure there before. It's the easiest from a filing and compliance standpoint, then the easiest to manage moving forward too. So last but certainly not least, and this one usually isn't the most fun to talk about, but we have to talk about it. It's organization. The number 7 smart tax move to save the most money moving forward is to get organized. You want to make sure you have the right documentation, because documentation is key. It's all about being proactive versus reactive. The number one thing is that we set up the proper infrastructure. So as long as we set this stuff up from the beginning the right way, that's going to be key to our success. We want to make sure we have the proper record keeping. You want to make sure you're working with a team of experts. And the ultimate goal is to get you to a point where you're audit proof. Clients are always asking us, what if we get audited? What if we get audited? Worst case scenario. That's what usually most people are concerned about. And I'm here to tell you, if anyone out there tells you that they can guarantee you won't get audited, that's not true. There's nothing anyone can do to guarantee that an audit won't happen. Actually, the more money you make, you're more statistically probable to get audited the more money you make. But what we can do is ensure that if an audit does happen, because in this environment they are a natural part of it, we can make sure you're audit proof. And we do that by doing all of these things right here. We set it up properly from the beginning with the right infrastructure. We have all the records in place, and we have a team of experts who can defend our position on all of these investments, campaigns, donations, and strategies that we're talking about. And so those, to recap, the 7 smart moves that we're advising people do prior to the end of the year. You gotta have a retirement plan. Adam talked to us a little bit about those. There's a ton of them out there, depending on your level of income. If you're a business owner, employee, there's a lot of different things that go into there to figure out which is the right one, but you want to have some sort of retirement plan set up. Talk about leverage investments. So this is the program Adam was mentioning in the natural gas program there. We have charitable marketing campaigns. Thomas, thank you so much. You described that very elegantly and very technically for us. We appreciate that. And we talked about depreciation, entity structure, family office, and being organized. So those are the 7 smart moves that we wanted to talk to you guys about today. If anyone has any questions, now's the time to put them in the chat. I'm gonna bring this down here, but we still got plenty of time. Like I said, our content section is usually about 35, 40 minutes, depending on what we have going on. We still got 15 minutes in our scheduled program here. So if anyone does have any other questions, pop them in there. We can pick these guys' brain for just a little bit longer. Thomas, Adam, before anyone types that in, I just want to thank you both for your time here and spending a little bit of time and educating us and entertaining us too. So
yeah, no, happy to be here. I got one more thing too. So I've got 3 little kids. I've got a 10-year-old and twin 8-year-old boys, and they're crazy. My 10-year-old daughter is a cupcake, right? But I want to talk about if you add kids to the payroll, where Jake, you talked about potentially adding 15 or paying them $15,000+ a year. Well, that's fantastic, and that's earned income. Well, if you have earned income, you can contribute to some of these retirement plans I was talking about earlier, one being a Roth IRA. So let's say we have a 10-year-old, my beautiful daughter. I start contributing, which, by the way, I do all this and some other stuff, and I'll share with you if you ever want to have a call. But a 10-year-old that we contribute $7,000 a year to. Well, let's just say that investment gets 8% annual compound growth. Well, at 10 years old, $7,000 a year, by the time they're age 30, that's going to be $320,000. If we do not contribute any more past the age of 30, that $320,000 is going to turn to $3.2 million by the age of 60, and that's all tax-free. So if you think about the power of compound interest, if you think about the power of just starting soon and leveraging some of these tax codes, talk about giving a legacy and teaching them how to save money and teaching them, really giving them a head start in their own financial independence. I love that. So some of these cool strategies are not just about me, it's about the next generation or a couple generations down. So Roth IRA for a 10-year-old, fantastic opportunity to really create some long-term legacy wealth.
Adam, I'm so glad you said that. I have a question there. Does that have to go in a Roth, or could they set up a traditional IRA for themselves, or could they just do like a managed stocks account if they wanted to?
Yeah, I mean, you could do traditional IRA, but think about the standard deduction of that $15,750. Not sure you would do that just because you may not want to. You're kind of taking tax deduction on tax-free dollars if you do it correctly. But you could do a 529 plan, right? There's a lot of changes that happen with education plans. They can be used for prior to college or trade school, so they can be used for private school, up to a certain dollar amount. And if they have the account for a certain amount of time, they could potentially roll some of those unused dollars, if not used for college, tuition, room, board, books, all the above. They could roll those unused dollars into a Roth IRA for the beneficiaries. So again, another way to say, hey, if we're putting too much money in a Roth, well, it's a lot more flexible now than it once was 5-10 years ago. So short answer, Jake, no, not a Roth IRA. They could do whatever they want. They could do an investment account like a UTMA. They could do cash value life insurance. They could do 529 plans. They could do really whatever they think is most appropriate for them.
That's awesome. And let's even say too, they could, because there's all these different asset classes, right? Everyone likes to diversify. If they wanted, the family was heavy in real estate investing, if they wanted to be saving that money towards a down payment on a rental property when the child got out of high school or out of college, something like that too, right?
As in funds from like a 529 plan?
So say we didn't use the 529 plan and we were just investing that money that they were paying the children, they could essentially use it for whatever they want down the road, right?
Yeah, you could do like a UTMA or UGMA, depending on kind of your area investment account. And then they get favorable kiddie tax up to a certain dollar amount. So that's got a lot more flexibility and liquidity, if you will, for things like that and other things. So, but yes,
nice. I like it. That's a really long way of saying yes.
Yes.
I love it. A couple questions. Peter asked, can you repeat the name of the MDS investment, please? I think it's
MDS, like Michael David Scott, Energy Development Corp. I have not Googled it just because I have kind of my inside sales or inside deck pages. MDS, let's see what it comes up.
That's the name of it. Peter,
while we're waiting there, Jake, I'd like to just second what Adam mentioned. You know, there's certain age requirements where, you know, children start to make sense to pay them. So I'll ask Adam the question, what age do you think a child could become justified to work in the business, number one? And then number two, I have my daughter doing the same thing. She supports my business administratively, and I'm able to shift some income to her based on her involvement in the business. Adam, what do you think is a good age to start putting the kids on payroll?
Yeah, so the IRS doesn't have a set amount. It doesn't say like you got to be 4 or 5 years old to be able to be on any type of payroll. But at the end of the day, they legitimately have to do real work. So they could do social media help. Well, a 4-year-old may not be able to do social media help. They could help with marketing photos. Okay, yeah, like I've had my kids in marketing photos since they were probably 2. We're sitting on we're all standing on a beach on the sand looking to the sunset. You can't see any of their faces because I don't want that to be whatever. That's creepy. I don't want people to see my kids' faces, but they're modeling, right? They're marketing, so I can pay them a fair wage. We do events, so if they're helping you with event setup or if they're helping you with filing papers, not that many people have papers anymore, but if they're helping you with some taking out the trash or stuff around the office, then yeah, that's legitimate work. Or if they're modeling for a website, that's all legitimate work. So it all adds up, right? If they're filing paperwork, can you pay them $15,750? That's probably not legit.
Probably not.
They're filing paperwork, they're a model, they're doing social media, they're doing other things, then yeah, that can absolutely add up to that. So to answer your question, Thomas, it depends on what they're doing. If you have really young kids, you're going to go more toward the modeling and marketing side of brochures and just things that you do, maybe even on social media. If they're a little bit older, like a 10-year-old, my 10-year-old probably knows more about social media than I do. I mean, not that she's on it, but if I gave her the ability, she would easily be able to help there. Or, you know, just things that I'm just not, you know, in touch with. So I'm not sure if that answered your question, but they have to do legit.
Yeah, look, I think it does. And I think, you know, the age does define sort of the role that they can take. But I think generally, you know, if you think about, you know, where your child could start to make an impact somewhere, it might be around the age of 8, you know, 8 or up, you know, like they start having the ability to handle responsibilities legitimately with proper direction, right? So again, you know, paying your 1-year-old, you know, is not going to make sense in the grand scheme of things, right? So just be careful and be smart about it.
The key word is defensible, Thomas. They got to perform an actual role in the business. We pay them in line with going market rates. And if we do, and then it all makes sense and we have the right infrastructure, we can do that. So another question here says, to open a Roth IRA, does the child not require to be 18? So I guess, can they open them under 18?
Yes. You would have a custodian, so a parent would maybe help from an ownership standpoint. But they, if they have earned income, that's really what checks the box to say we can now contribute to a Roth in this case.
Nice. And that's what we're fulfilling from paying them from the business. Awesome. If anybody else has any questions out there, type them in the Q&A box. We'll be on here for a few more minutes. If nobody else does, I always take that as a compliment. That means we covered everything so efficiently and so effectively that nobody could have a ton of questions at the end. But if you're out there still, you do have some questions, please pop them in the Q&A box. We'll all hang out for another minute or two here, and we'll take it from there. After that, we'll let everyone get back to their day. So Adam and Thomas, thank you so much once again for taking time out of your day. Really appreciate it.
Yeah, thank you, Jake.
Yep.
I'm sure the three of us will be discussing quite a few client scenarios prior to now and the end of the year. So.
Okay, welcome that. Take care. Nice to meet everybody.
Absolutely.
All right.
Thanks, Thomas. All right, if nobody else has got any questions, we'll drop off here. We'll give you a couple minutes back in your day. Thank you so much. I'm Jake Alexander from Action Accounting. We'll talk to y'all soon.
See ya.